Sir, as you rightly pointed out, ratings are a very important part of the overall credit process. So, any organization which wants access to finance, if it has got a strong credit rating, that gives a lot of credibility, because ultimately, sir, rating is an independent evaluation. So, a rating agency evaluating an entity based on the information which has been received by them from the market and from the other relevant sources, rating agency arrives at a rating which is available to everyone. Now that helps in basically reducing the information asymmetry. So a rating basically reduces the overall financial analysis or the business analysis to a single digit or a single number. So a triple A basically justifies a very strong credit profile, whereas a double B or single B, it signifies a risk. So what happens, sir, as you pointed out, sir, in the beginning, that getting access to credit is basically becomes challenging in case the lenders don't know you. If you are a startup or if you don't have a good track record, so that becomes a big challenge. Now, lender community will like to see some track record, some credibility in terms of whether they want to take exposure on you or not. So if you have a rating with you, which gives the credibility, so that part becomes a bit easier, because a bank can depend upon the rating as well. Although, as sir has pointed, Ajay sir has just pointed out, in terms of they do their own internal analysis as well. So that's one part. But a rating which is given by a third party, if that is available in public domain, so the lender also has a increased confidence in terms of the credibility of the organization on which they are taking the exposure. So basically, it bridges the gap between the lender and the borrower. So that really helps, and it also, as was pointed out, a triple A may ask for a better rate. So what happens, sir, is if rating also helps in terms of discovery of that rate. So although banks may have their own methodology in terms of arriving for rates, but basically rating can help in terms of giving a equation between a risk and the return premium. So what kind of risk banks are ready to take for a particular rate, that basically is something which rating can help them. So a rating helps in arriving at a particular rate, arriving at a particular amount for of debt which can be borrowed. So all those things can give a better access to finance, as lenders would be aware about the kind of risk they are taking on a particular entity based on the rating which it has. That's one part of it. If you look at the other part, in terms of the information which the rating agency puts in public domain through their press releases or their rating rationals, now that rating rationale will have a good information in terms of the overall business profile of that entity, the kind of business risks they take, the kind of promoter strength they have, the kind of financial strength they have, the future outlook for that entity. So all those factors, if you combine, there's a good information on that entity, which can be used not only by the lenders but for other sources of finance as well. So there are now fintechs coming up. There are other private equity players also, which are in lookout for entities which are good, which are upcoming. So information available about an entity which is rated, that can help that entity can get access to various sources of finance. That is only one part, sir. But also that entity can also look at self correction based on that rating. The entity may get a particular rating, and that rating could be a result of various strengths and weaknesses. So if a third party evaluator like a credit rating agency, it gives them some kind of guidance in terms of what is your weakness and how you can overcome that. So that is also one part which can help them to improve upon those things, and can also lead to better access to finance, as you pointed out, sir.
Sir, what are the factors, sir, you are considering while awarding a rating? That
So,
you
sir,
can do something,
yeah,
sir?
sir, it's a combination of various factors, sir. We look at the kind of industry the company operates in, what is the industry dynamics, in terms of what is the overall financial profile of the entities operating in that industry. We look at that quite closely. Then we look at the business risk of that particular entity which is being rated. So, what kind of business position it has, competitive strength it has. So we look at the overall business profile of that entity in terms of how much operating efficiency it company has. So we look at those factors. Then we look at the financial profile of that entity in detail. So we look at the profitability, we look at the leverage profile, we look at the overall debt levels, and what kind of coverage ratios they have going ahead. And one of the most important part is on the management. So we look at the kind of management they have, the kind of strategic initiatives they have been taking, the risk-taking ability of that management, the corporate governance practices. One of the most important parts, as Ajay sir also pointed out in the beginning. So it's a holistic assessment of the overall enterprise, and which is also published in a rational. So any user of that rational will also get to know about how the rating agency has gone through the whole exercise and how they have arrived at a particular rating. So that's a value added response which a rating agency gives to any assignment, sir.